Welcome to WAQAR'S FINAIRES, where we make finance simple and practical for your everyday life. You're buying a home, now what? Let's talk loans. So, you've decided to buy a home? Huge congrats! That's an exciting milestone. But before you get too carried away, here comes another important step. And trust me, it's just as crucial: finding the right loan. Here's the thing, just like you wouldn't settle for the first house you see, don't just accept the first mortgage offer you come across. Why? Because there are thousands of lenders, big and small, all vying for your business. If you dedicate even a small portion of your time to shopping around, you're likely to find a much better deal with a lower interest rate and fewer fees than the initial offer. Start loan shopping before you house hunt. A lot of people think, I'll find a house first, then look for a loan. But actually, it's a lot smarter to do it the other way around. Why? Because getting pre-approved for a loan before you start searching for a home means you'll know exactly what you can afford. You won't waste time looking at homes beyond your budget. You'll be a stronger buyer. Sellers love pre-approved offers. So before you start picturing that dream kitchen or backyard pool, focus on locking down the best loan first. It's not just about interest rates. Most people only focus on finding the lowest interest rate. And while that's definitely important, it's not the only factor that matters. You should also pay attention to points, closing costs. Why? Because these can significantly affect the total cost of your mortgage. What are points, and should you pay them? Points are upfront fees you pay in exchange for a lower interest rate. Each point is equal to 1% of your loan amount. For instance, let's say you're borrowing a $250,000 mortgage. 1 point would cost you $2,500. But here's the interesting part. Paying points could save you tens of thousands of dollars over the life of your loan, especially if you plan to stay in your home for a long time. So, don't automatically rule out points just because they increase your upfront costs. They could be a wise investment in the long run. Closing costs, the sneaky expenses you need to know about. Closing costs are additional fees you'll pay for various services. Things like title companies, escrow agents, government agencies. And let's be honest, these fees can add up quickly. That's why you should always request a detailed list of fees from lenders so you can compare the true cost of each mortgage. Want a simple way to track it all? Use a comparison chart. You can print as many as you need from www.wsj.com/booktools. This will allow you to compare offers side by side and make the smartest choice. Timing is everything. Here's something a lot of people don't realize. Mortgage rates change daily, sometimes several times a day. So if you get a few loan quotes today, then a few more next week, you're not getting an apples-to-apples comparison. Instead, try to gather all your quotes within the same time frame. That way, you'll get an accurate picture of what's available. Now let's talk about today's market, because things have shifted. With rising interest rates currently averaging around 7% and increasing closing costs, shopping around has never been more crucial. In fact, recent data shows that the average closing costs in the US are now about 2% of the loan amount. That means on a $300,000 mortgage, you're looking at around $6,000 in closing costs. That's a lot of money. And yet another reason why it's essential to shop for the best deal. Bottom line, don't settle. Yes, shopping for a loan can feel overwhelming, but trust me, it's worth it. By taking the time to compare interest rates, points, closing costs, you could save thousands of dollars over the life of your mortgage. So take your time, ask questions, and don't settle for the first offer you get. Tax savings, one of the best benefits of homeownership. Owning a home isn't just about having your own space. It's also an excellent way to save money during tax season. And let's face it, who doesn't enjoy a good tax break? So today, we're going to explain exactly how homeownership can help you keep more money in your pocket. Let's dive in. What can you deduct? The IRS allows homeowners to deduct two major expenses: mortgage interest, property taxes. But here's the catch. You'll need to itemize your deductions using Schedule A. That means your mortgage payment isn't as expensive as it seems because you're getting some of that money back in tax savings. Sounds great, right? Let's walk through how it works with an example. a real-life breakdown of tax savings. Let's say you purchase a home for $200,000. You make a $40,000 down payment and take out a 30-year mortgage for $160,000 at a 6% interest rate. Your monthly principal and interest payment? Around $959. Now, add in property taxes, $150, home insurance, $100. So your total monthly payment is $1,209. Now, here's where the tax savings kick in. In your first year, you'll pay approximately $9,540 in interest, $1,000 to $1,800 in property taxes. That's a total deduction of $11,347. And that deduction lowers your taxable income directly. So, how much will you save? Let's assume you and your spouse earn $100,000 together and file taxes jointly. Your marginal tax rate might be 25% federal, 4% state, totaling 29%. Now, multiply your tax deduction by your tax rate. $11,347, 29%, $3,290 in tax savings. That's an extra $274 per month back in your pocket, which means your effective mortgage payment isn't actually $1,209. It's closer to $935. That's a big difference. Understanding marginal tax rates, why it matters. Let's take a quick moment to explain how tax rates work. Because many people think, I'm in the 25% tax bracket, so all my income is taxed at 25%. But that's not the case. Your income is taxed in layers. For example, if you earn $100,000, the first $14,000 is taxed at 10%. The next $44,800 is taxed at 15%. And only the highest portion of your income is taxed at your marginal rate. That means tax deductions like mortgage interest reduce the highest taxed portion of your income first, which maximizes your savings. Tax laws evolve regularly, so let's quickly review the latest updates. According to the IRS's most recent guidelines, the standard deduction has increased and tax brackets have been adjusted for inflation. For example, the 25% tax bracket now applies to incomes between $89,000 and $170,000 for married couples filing jointly. So it's always wise to check the latest tax rate schedules at www.irs.gov to calculate your exact savings. The bottom line, tax savings make homeownership even more rewarding. Owning a home isn't just about building equity. It's about keeping more of your hard-earned money right where it belongs, with you. By deducting mortgage interest, property taxes, you can save thousands of dollars every year. And those savings? They could fund more vacations, more investments, or just provide more peace of mind. So when you think about homeownership, don't just consider the house itself. Think about all the financial benefits that come with it. Because in the end, a home isn't just a place to live, it's a smart financial decision. This video was brought to you by Books and Tax Professionals, a team of expert accountants dedicated to helping you achieve your financial goals. Whether you need accounting, bookkeeping, or virtual CFO services, we've got you covered. Visit our website or contact us today for a consultation. If you found this video helpful, don't forget to like this video, share it with others, subscribe for more financial tips and advice. Remember, every small step you take toward financial literacy brings you closer to your dreams. Thanks for watching, and we'll see you in the next video.